So perhaps quick introductions. My name's Nathan Pryor. I'm from Partners Wealth Management, and I lead our financial planning service for international individuals and residents here in the UK. We also have waiting in the wings my colleague Kat. You may hear my voice is faltering slightly, so if I do duck out, Kat might jump in and save me or help during our Q&A session. Brian, would you like to introduce yourself?
Yeah, my name is Brian Dunhill. My firm Dunhill Financial concentrates on American expats here in the UK and around the world. We offer all of our platforms through our partners like Nathan, and robo services for those that are emerging affluent through dfdirect.com. So nobody has an excuse of not being able to get started their financial planning journey right away.
Excellent, great. So if we skip forward a couple of slides here, that's our disclaimer, which everyone can have a quick read of. If we skip through again. So what are we covering today? So we thought we'd start with just a review of what exactly financial planning is, then specifically focusing on what additional hurdles there are for Americans living here in the UK. And then we will go into our kind of suggestions or comments on what you need to think about when investing as a US taxpayer here in the UK, what your financial planning priorities might be or where you want to start. We'll have a bit more of a deep dive into UK pensions and US retirement plans. And we thought we'd also touch on savings considerations or accounts for children or grandchildren. As I say, along the way, please do ask questions through that Q&A function, or if you wish, save them up to the end and we will try and answer as many as we have time for. So we've introduced ourselves. There we are again, but let's start off with what is financial planning. So I'd like to just start with the idea that financial planning isn't a one specific thing or a one event transaction. Financial planning is something that is an ongoing, evolving kind of thing that you really want to do at various stages or consistently throughout your financial life. This chart here that you're seeing up on the screen, you can look at that and pretty much everyone can probably see roughly where they are on these different stages, whether that's what we'd kind of call the wealth accumulation stage, where you've kind of started working, you're building up your finances, and perhaps kind of most important things in your life are having enough money to live on, protecting yourself from a health or financial point of view. Perhaps you're thinking about getting a mortgage, saving for certain things. Then you get into what we call the wealth enjoyment phase, which we all enjoy, of course. That's where you've got those kind of basics covered. You've perhaps got a little bit of extra cash, and you're starting to think about additional things. Perhaps you're starting to think about, well, how do I make sure I've got enough money to create my financial freedom, the moments where you no longer perhaps need to be reliant on work. You can retire, live off your savings or your pensions or whatever your personal goals might be. Then we have the wealth decumulation stage. Others might call it retirement, which, you know, some people dislike that word because retire means to be put out of service, and of course we don't want to be put out of service. We want to just enjoy our financial freedom. But of course, different things will be kind of top of your priority list at that point. Perhaps you're thinking more about, how do I pull money out of my savings in the most tax efficient manner? Perhaps you're thinking about, how do I protect myself from a long-term care point of view? Or perhaps, how do I start to pass wealth down to children, grandchildren, or other individuals like that? So across financial planning, it will be different for different people depending on what your stage you're at. But a common thread that goes through financial planning is the idea of wanting to be efficient and wanting to do things now that not only help you now, but also set you up well for the future. That might be considering tax optimization, it might be considering flexibility, it might be considering how to optimize your savings and your investments. But by doing some financial planning, by building a plan for yourself, what you are doing is allowing yourself to make decisions today that take into consideration what potential objectives you've got in the future, or what things might you want to protect yourself against in the future. So you can make better decisions today, or at least make decisions today with some kind of real idea of how that's going to impact you later down the line. So with that being said, what are the additional considerations that US taxpayers living here in the UK need to think about? Now, I say US taxpayers there because as a US citizen or a US person living in the UK, you'll still be required to report your finances to the IRS, your income, your capital gains and things like that, as well as to the UK. So you have a double tax situation. Now, fortunately, there are lots of tax treaties and good tax treaties between the UK and the US, which mean that you shouldn't pay tax twice. You shouldn't have double taxation. However, those treaties and the circumstances around that are not always kind of very clear as to how they work, or they're not very easy to follow without really understanding the rules and making sure that you're complying with the terms of the rules. On screen here, there's a few kind of abbreviations, a few words that you could pick out, and some you may be aware of, some not. There's the dreaded FATCA and PFIC, which can often cause lots of harm. If I take PFICs, for example, that is when you're investing in non-US investment funds, passive foreign investment companies. And whilst they might be perfectly well suited for an individual here in the UK, they might be really tax efficient for somebody here in the UK. But actually, for a US taxpayer, they could actually be quite detrimental. So therefore, we need to be aware of these additional circumstances, these additional considerations, and put them into your financial plan to make sure that they don't cause you any pitfalls along the way. Brian, I think currency is one of the things that we've often spoken about as being one of those things that can often impact people when talking about investments on these as well.
Do you mind if we have a little bit of fun on the four-letter bad words that you just brought up there with PFIC, and we'll unravel it just a little bit more if you don't mind, Nathan. Don't worry, I'll do the talking so that you can relieve your voice just a little bit. So when we're looking at PFIC, like Nathan said, we're really describing anything that's invested in a foreign collective. So if it looks like a mutual fund, but it's managed over here in the UK, it's probably a PFIC. Now, the thing is, there's kind of several different breakdowns that it could go down. If it's inside of your pension, your corporate pension, there's not much you can do about it. Now, should you report it as a PFIC? Some accountants will. Some don't. The thing is, because of the relationship of the double taxation treaty, whether you're reporting it as a PFIC or not, there's no tax on it. It's deferred, so it doesn't matter so much. So naturally, you want to take those extra benefits. If your employer's paying you, say, 5% or 10% matching, make sure to take it. Don't be scared away by that PFIC exposure, no matter which way your tax accountant declares it. It's when you have an ISA or just a general investment account that it really matters. You don't want to own those PFICs inside of there. So to me, there's two different determinations that you don't want to get scared away from using the corporate pension schemes over here for a PFIC, but you want to stay away from those when it comes to the others. Sorry, we were going to go to currencies. I just didn't want people to give up on those pensions, especially with the new elections.
Yeah, no, most definitely, and we'll circle back round to pensions. But yeah, just slightly off from kind of tax, which is as fun as that is. Kind of practicalities wise as well, currency for me kind of fits into that bucket, and depending on one's past circumstances or future considerations, currency can use this better than me, Brian, but I can never seem to guess which way currencies are going to move one way or the other from year to year, whether the dollar's going to be stronger or the pound's going to be stronger. So when investing, how best do we plan for that?
Absolutely. I think currency is the biggest thing that can help or hurt your portfolio. And the problem is it typically goes in 10 to 15 year periods of being one directional. So we probably remember 10 years ago having a, pound to the dollar at 175, 180. And now we've gone full circle back down to 106 and trading back into the 120 area. Now, essentially, if we're able to invest more of our risk-free assets in the currency that we're going to need the funds, we're eliminating a risk. This is called a natural currency hedge. That doesn't mean we want to have all of our investments in UK instruments, because a lot of the growth actually comes ex-UK. But for instance, if you're building a portfolio that's half stocks, half bonds, the more UK-centric bonds we have, the less risk we have in that portfolio, that being that natural currency hedge. Now, this goes whether you're building investment vehicles here in the UK, so those pension pots or such, they probably have a little bit higher portion that's invested in pounds. Or if you're making your investments in the States, let's say you have an old IRA in the States, an old 401k, or anything of the such. If you're planning to retire here in the UK, make sure to have that bigger tilt towards pounds or the currency you might be moving to. Some of you might decide, I want to go to Europe when I retire. So then you want a more Euro-centric portfolio, or if you're going back to the US, it would be US-centric. To put this in terms, about 57% of the world's market cap, so if we took all the companies around the world, added up their market cap, 57% of them would be US. The typical US allocation is between 80 and 90% US dollars. That means a natural hedge towards the US. So if you don't navigate that and try to reduce that, in periods like the last 14 years, you would have been doing great because the dollar was going up. But historically, over the last 50 years, since we went off the gold exchange, essentially we've had 10 to 15 years of the dollar being strong and then 10 to 15 years of the dollar being weak. So to Nathan's question of which way could we be going? Well, we've had 14 years of dollar strength. And now all of a sudden we have almost the same impacts that led to the G7 being formed and the Plaza Accords taking place, which ended up actually pushing the dollar down significantly. We have high inflation. We just got the new number here in the UK of 10.1, which surprised everyone on the high side. That led to higher interest rates, and higher interest rates led to essentially a forceful push for other countries to sell the reserve currencies. That was the first G8 summit at the Plaza Hotel in New York. Now, whether we're going to have a Plaza type of moment this year, which is going to force the dollar down, I'm not sure. But what we do know is that we're seeing a lot of growth outside. And as interest rates start to move up outside of the United States, we should see that balancing out. So make sure to remove risks instead of speculating towards risks. And that's having the right money in the currency that you might need. Now, I think Nathan is still struggling to get back in, or have you been able to get back in, Nathan?
I think I'm back. Thank you.
Oh, perfect.
And it sounded like you concluded on exactly my my point of remove risks where possible, rather than try and play around with them. Yeah.
Exactly.
I think the last bit I did just want to touch on when thinking about hurdles is it's not just one way. It goes both ways. So you have the considerations of what reporting you need to do to make sure you're efficient whilst in the US, but also vice versa. Obviously, you're here in the UK, you need to report to the UK, and so making sure that you're complying with both situations. Now, there's certain places where that potentially gives you slight restrictions on what you can and can't do, but there's other places where perhaps there's kind of slight benefits of being able to kind of play the benefits of two systems. Especially as we'll come on to when it comes to if you've got savings in both the UK and the US from a pensions and a retirement planning point of view.
Yeah, we get that question quite a lot. Should I report this? And the answer is yes, you should always report it on both sides. The question that should be asked is, will I be taxed on this? And that's to where we have one of the best double taxation treaties. But report everything to both sides. Don't skip.
That's right. It's a little bit of extra administration, perhaps, to make sure everything's reported in both places. Most of the time, it is just administration, and you'll only be taxed once. But making sure that you've reported to both places ensures you don't get in trouble with one or the other. Let's move on to the next part of our agenda, which, if I'm right, is when we're considering PFICs and the UK reporting status. That does slightly constrict what you can potentially invest in when you're outside of those tax efficient wrappers. Brian, how do you kind of meet that challenge?
Absolutely. So if we're investing in a taxable account, so if we have money outside of an IRA or a SIP, the SIP being the UK retirement vehicle, we're able to buy any individual stocks or individual bonds without any problems. So if you got allocated company stock, don't worry, you don't have a PFIC. They're individual stocks, whether it's on the London Stock Exchange, Frankfurt, or the New York Stock Exchange. You're fine from a reporting vantage point. The question will be whether you get the right reports, i.e. the 1099 in the US, or you need to produce something with your accountant. Now, most of the time, you'll want a little bit more diversification than having single stocks inside of a portfolio. And this is to where it becomes a little bit of a crunch, because most people would buy managed funds to do so. But essentially, any managed funds on the UK side would be considered a PFIC on the US side. So you'll get negative ramifications from holding that. And any managed fund on the US side will essentially not be approved for HMRC vantage points, which Nathan will go into. So you'll end up paying a little bit more tax. So we'll concentrate mostly on buying exchange traded funds, but you need to make sure that they're only the funds that are on the HMRC list, so that you get the lower tax bracket and that you're able to build that portfolio with those. All of our portfolios that we have listed with our robo-advisor, with our partners like Nathan, every single one of the funds are HMRC compliant, so they go at the lower tax basis. And that gives us a globally diversified portfolio in the UK side with a higher natural hedge, like we were talking about, to pounds, so that if the pound goes up, we're not getting hurt so much by having mostly a dollar-based portfolio. And that keeps us in compliance both on the US side, removing the PFICs, on the UK side, having everything be HMRC compliant, and receiving our 1099s and the likes.
I think the important part on this is that you are very much able to build, manage, and maintain a very sensible, well-diversified portfolio that meets individuals' needs, meets individual risk requirements, etc. But what you need to make sure is that you don't fall foul of these rules. I mean, if we take the UK taxing part, for example, if you were to go and buy some US mutual funds that were not on HMRC's UK reporting status list, the effect of that is essentially you pretty much double your tax rate in the UK. So, for example, you buy an equity fund, the equity capital gains tax rate in the UK is 10% or 20%, depending on whether you're a basic or higher rate taxpayer. But if you buy a fund that is not on that reporting status list, you don't get the benefit of that capital gains tax rate. You're instead going to have that applied at income tax rates, which double to 20 or 40%, or if you're an additional rate taxpayer, 45%. So you're at least doubling your tax rate by not picking those UK reporting status funds. So it's quite important to do so. Now, there might be, the odd occasion where there's a particular fund that you really like and might give you, particular exposure, and you think, hey, I'll suffer the additional tax. But you really need to give it quite some thought to make sure that actually it's going to be so much better than a reporting status tax efficient fund that paying double the amount of tax is worthwhile. And there's probably not that many cases where it's very clear that you can convince yourself of that. So shall we move on to the next part of the session here and think about when we're looking at financial planning and as a US person here in the UK, what potentially should your priorities be? What should you kind of target first, or what are the things that you should have in mind as the top of your checklist? Now, for different people, different things will perhaps be at the top of the priority list, depending on where you are and your stage and your personal objectives and things like this. But we've just kind of thought here about some of the kind of key things that are quite often on the top of people's planning priorities once we've spoken to them and understood their objectives. Now, at the top of our list here is tax planning, and probably that is one of the most important things, because that will run through pretty much all circumstances or all situations where, if you can get the tax efficiency right, that can help you, as we've said, now, in the future, and perhaps when you're kind of drawing down or passing on assets. And we've already spoken a little bit here about making sure that you're efficient both from a US tax point of view and a UK tax point of view when you're residents here. One of the next bits, which are probably most important in relation to that, is retirement planning. And I would say that because retirement planning and the use of retirement accounts, be it in the UK or the US, is probably one of the most efficient ways to save as a US taxpayer resident here in the UK. The treaties between the US and the UK on retirement accounts and pensions are very strong. It means that you can make use of the availability of allowances and tax savings there to do that. And it often also means that once you've got money inside these accounts, as Brian was saying earlier, you don't need to worry about those PFIC considerations or the UK reporting status considerations. So quite often when people kind of say to me, hey, look, where should I start saving? I quite often say, well, does your employer have a pension scheme? Yes, in the UK, it's a requirement that if you're employed, they do offer you a pension scheme. Probably one of the best places to start saving is to make use of that pension scheme. Make use of any allowances your employer gives you. Quite often, they might give you additional benefits like matched contributions and things like that. That is probably the best place to start saving, because it's going to be relatively straightforward. It's going to be tax efficient for you. And probably quite good value for money if they brokered a deal on an institutional basis. What you do, of course, need to have in mind when looking at that is, well, if you put all of your money into retirement accounts, what are you going to live off today? So there does need to be some planning around that to think about, actually, I need to balance up how much I put into the retirement savings in order to get all of those great tax benefits versus, I don't know, maybe you're in your 30s or your 40s and you've got some other objectives along the way. Perhaps you want to buy a house, perhaps you're going to have kids and need to pay for education or whatever it might be. If you've locked it up into a pension or a retirement account, that's then going to be difficult or potentially not possible to pull that money out before your retirement. Currency, we've kind of covered that a little bit, Brian, a little bit earlier. And so it kind of next really goes into kind of broader investment planning. And that really does mean thinking about that balance between near-term, medium-term, longer-term investments and savings, and when you're going to start accessing them, and making sure you're aligning your investment strategy to that plan. So by that, what I mean is thinking about buckets for your investments. So your pensions, for example, they might be invested for decades. You know, if you're at the start of your accumulation journey, now they might be multiple decades of investment. So perhaps you can think in there about much longer term investment strategies. Can you afford to take a higher level of risk in there because you're not going to be so concerned about the year to year mark to market values of those portfolios? Whereas nearer term savings that perhaps you're building up a deposit for a house purchase, or you need some money available to kind of buffer you from any emergency expenses, those kind of investments are going to be quite different. So you need to kind of have a bit of an idea as to what the investments are for, and therefore align that to those objectives and those strategies. Now, finally, and this probably isn't for everybody, because there are people obviously at different stages, but towards the latter end of your financial kind of time horizon, estate planning tends to be something that starts to come into people's minds. And actually, I would say estate planning is best started a lot sooner than people often think, because the sooner you start thinking about your estate planning, actually the easier it is. Now, an important thing here is that in the UK, your estate taxes, or what's called inheritance tax here in the UK, starts to be applied a lot earlier. So quite often your house probably covers your basic band of tax-free allowance in the UK. So you could potentially be subject to 40% inheritance tax on quite a lot of your assets on death. So the earlier you start thinking about, how do I align my savings and my assets into structures that might be exempt from inheritance tax, or potentially, how do I start transferring assets to my beneficiaries, perhaps before my death? You know, if you don't necessarily need those assets yourselves, can you transfer them down beforehand in order to start moving things outside of your estate? So those would be the kind of the key things that I would outline there. Any other topics that you often find come up, Brian?
I think those are great ones, and I think for estate planning, to me, it's starting out with those important things, especially if you have children. Who would take care of the children? Especially if you're abroad and all the families back in the States. That's something that really needs to be thought and placed through. And it's much more important when you're an expat in a foreign jurisdiction. So I would definitely concentrate on those attributes and not just the financials. It's the important things in life.
Yeah, that's exactly right. You know, having your documentation to say who your power of attorney would be, who your executor would be, make sure you've got will in place. Sometimes it might make sense to have a will in both the US and the UK, if you've got assets in both jurisdictions, to make sure there's no kind of question as to how that would be followed.
Yeah, I tend to find that a lot of times You can simplify it with having one in this jurisdiction that covers back in the States. It's only if you have lots of things that are identified over there, because you want to make sure you don't want to have crossover right there. The one states one thing and another states another thing, because then it just goes straight back to probate and you're back to square one. You might as well not have filled anything out. So make sure if you have that it's a coordinated strategy between the two to put that together.
Very much so. Okay, shall we start talking about these details of pensions then? I think we're starting here with yes, UK pensions. And unfortunately, in between us starting to put together this session and today, we've had a budget in between that's changed the rules as well. So we've got a few differences here to how we originally kind of put these bullet points together. But I think kind of the key elements are very much still there. UK pensions are a savings vehicle where you can pay in your income on a pre-tax basis. That means rather than your employer paying you the income and you paying income tax on it, instead you can say, please employer, transfer that money directly into a pension and therefore you do not pay tax. So you could be saving 20%, 40%, 45% income tax on those contributions. That sounds great. There are limits to that. The limit has just been increased this year so that you can pay to £60,000 per year of your income into that tax-free. There are additional rules on that, in that if you haven't used your allowance in previous years, you can go back up to 3 years to use previous allowances as well. But importantly, it must be matched off against relevant income that is suitable for paying into a pension. One of the things to bear in mind is that if you are a higher earner and your earnings exceed £260,000, that £60,000 limit does start to get reduced. For every £2 additional you earn, you lose £1 of limit. So you need to be mindful of that, just to make sure that you don't cross over those limits. Now, one of the things that is in the middle of being changed is what's called the lifetime allowance. One of the big differences between the US and the UK is that in the UK, there was something called a lifetime allowance on how much you could put into a pension, and for that to be not subject to what was called excess charges. Until recently, that lifetime allowance number there, 1,073,100. Why did we get to that number? Well, it started at 1 million and started getting indexed to inflation. But critically, what was the case is that if you exceeded that allowance, or if you had any specific protection, your protected allowance, you were subject to an additional lifetime allowance charge. Now, that has been changed in that excess lifetime allowance charge is no longer applied, but that lifetime allowance number is still there and is still relevant. And the reason that is relevant is because your second benefit of having a UK pension, the 25% tax-free lump sum, is now capped at that number. So £1,073,100. You can get 25% of that as a tax-free lump sum when you draw on your UK pension. That is obviously quite an attractive benefit if you've been able to pay into the pension before tax and then take a quarter of it out tax-free. And in the meantime, being a pension, you've had growth within that pension, which you've not had to pay tax on as well. So this is a pretty attractive way of saving. Now, as I mentioned, the downside to pensions in the UK is that you are locked into the pension. You are not able to start taking withdrawals out until you hit the minimum retirement age, which is currently 55. It's going up to 57, and I would guess over time it will keep kind of creeping upwards. And that's a significant thing to bear in mind. It's again slightly different to US retirement schemes, where you can take money out earlier but pay an early withdrawal charge. In the UK, you just can't take the money out earlier unless you have specific health considerations. One of the final bits to think about in UK pensions as you get towards that time when you start drawing on them is that based on changes to UK pensions a number of years ago now, we now have something called pension flexibility, which means you have the complete ability to do whatever you want with your pension. That means you can leave it all in your pension, never touch it. That might be attractive because UK pensions from a UK inheritance tax point of view are not subject to that 40% inheritance tax charge. So that could be quite attractive when you're thinking about your estate planning. Or on the other end, you might decide to take all of it out of your pension. Now, one of the concerns when these flexibilities were brought into place was that pensioners would all of a sudden start taking all their money out and buying Ferraris and things like that. Now, that hasn't happened too often, although I'm sure it has once or twice. But of course, if you were to take it all out in one go, you would be having to consider what income tax you would have to pay on that. As I say, only the first 25%, it could be tax-free, and the rest probably subject to fairly high rates of income tax if you're taking it all out in one go. I think we can move on to US retirement schemes, and perhaps Brian, if you can run through these ones.
Yeah, so we have several vehicles in the US. They have all kinds of different codes, but the traditional one is a traditional IRA. Now, you might have a 403B or a 401k. It will work in this similar format where you end up getting a tax-deductible contribution if you were in the States, and then it grows tax deferred to be taxed when the money comes out. Now, if you're here in the UK, most likely, in most situations, you're going to pay more tax here in the UK than you would have due in the United States, which would mean if you took the foreign earned income exclusion, you would not be eligible to make a traditional IRA contribution because you'd have no income on the US side. It would all be canceled out by the FEIE. Now, if you wanted to continue making that traditional IRA contribution, you could go ahead and take the credit system where you basically apply the credit of the tax you pay here in the UK against what you would owe in the US, and you make the traditional IRA contribution first, still owing no money. Now, what's nice about this is if you're over the Roth IRA contribution limit, which first let me pause and describe what that is. A Roth IRA is an IRA in which instead of getting to deduct it from your taxes now, you pay the taxes now, it goes in, it grows tax-free, and it comes out tax-free, which can be quite advantageous. What we can do is what's called a backdoor Roth IRA. So you make the contribution, you set your taxes up on the credit system. We make the contribution to a traditional IRA, and right away we convert it over to a Roth IRA, which means it grows tax-free. You therefore pay the same amount of tax as you would otherwise, but you have the money freely growing to take out without any tax when you're ready to take it out, which is recognized both sides on the UK side and the US side, so it doesn't matter where you reside. Now, essentially, here, similar to the UK, you can't take it out until you're 59 and a half. There's a few more exceptions on the US side. You can use it for education. You can use it for health needs. You can use it for up to $10,000 for a house purchase or regular payments, so annuitized payments. So, for instance, if you retire at 55 and you annuitize it to where you're taking equal payments, you will not have an additional 10% penalty on top of your tax to take the money out before 59 and a half. But otherwise, you will be hit with a 10% penalty. The traditional IRAs will get hit with what's called a required minimum distribution, which seems to be eking up every couple of years. It's currently 73 years old. It's another advantage of having the Roth IRA. You won't have to start taking that out. Now, in the first years, what they do is they take a life expectancy, and you have to take one portion of that. So at 73, the average life expectancy is about 20 years. Therefore, you have to take 1/20th out of your traditional IRA. Now, that's a smaller amount, but if you have a lot in your IRAs, if you get to the age of 100, your life expectancy is 3 years, so therefore you have to take a third of it out in that given year, and that can hit you with significant tax amounts. Therefore, if you have a large traditional IRA that you've rolled over from a 401k or the such, you might want to look at some strategies of actually transferring some of it and prepaying some of the tax to get it into Roth IRAs, so that as you get older, you're not forced to take full taxes in given years. So it's optimizing your tax over the course of time. And these are great things to be able to do while you're abroad, especially if you have gap years without earned income or the such. And that's where you should be looking at optimizing those strategies with those old 401ks, IRAs, and such in the States, to make sure that they work for you in the best of ways, whether you're here in the UK or the US.
Yeah, and I think this is kind of where I was kind of looking at when you've got both US retirement plans and UK retirement plans, those slight differences between the two, and understanding how those differences work over time. You can start to kind of update your plans and tweak your plans to use those efficiencies and smooth out your income streams to make sure that you're not just building up higher rates of taxation later down the line. One of the strategies we kind of look at for some people, for example, is if they have kind of managed to retire early at 55, say, started taking income from the UK pension, they can then pause that when they hit 59 and a half, and instead start drawing from the US IRA instead, bearing in mind and thinking about the idea of not necessarily wanting to just continue to build up that traditional IRA and then be forced to take large distributions later, especially if those distributions are then going to be in excess of what income you actually need, because then you're just paying tax on income you don't really want or need. So if we can tweak that, balance that, and make sure that you're smoothing your income requirements and needs to meet what you're potentially trying to achieve from an expenditure point of view, minimize that taxation rate longer term, and potentially then leave whatever kind of excess retirement funds you have, perhaps in that Roth IRA where you're not forced to distribute it, or in your UK pension where you can leave it in there and it be outside of your estate from an inheritance tax point of view. Those are going to be really useful for you, but perhaps got nothing to do with meeting your expenses needs.
And it, like you said earlier, it actually doubles up as helping you for estate planning.
That's it. So next bit, I think we're going to start moving on to talking about saving for children and grandchildren, which is, very much it does start thinking about that estate planning. Perhaps people don't necessarily always think of it as estate planning, because if it could well be, actually, this is education planning. How am I going to cover those educational fees for my children as they get older? Is there an efficient way to do that? In the UK, quite often people default to using junior ISAs. Now, we've already heard how ISAs can be challenging from a tax point of view for Americans here in the UK, and junior ISAs very much so. I would say 99% of junior ISAs only offer you PFICs to invest in. So you pretty much have a choice of cash or PFICs, neither of which necessarily an exciting option. But Brian, there's potentially some US plans that might be worth considering.
Absolutely. Well, actually, I don't know if you saw in The Economist a couple weeks ago, it stated that the average education, university education in the UK is now more expensive than the average university education in the US. And
That's interesting. Yeah,
I
oh, yeah.
was dumbfounded by that because naturally we always see those heavy prices in the US, but they've accelerated very quickly over here in the UK.
Yeah.
So it used to be my kid's not planning to go back to the US, so therefore, do I really have to plan for it? The answer is yes. The
Yeah.
cost has gone up significantly. Now, there are several plans that have tax benefits on the US sides, and then I'll get into some of the problems with them. The 529 is one of our favorites because it grows tax-free. And now with new legislation, if your child doesn't use the funds, you can go ahead and convert it into a Roth IRA. So the child ends up having this pot for retirement that grows tax-free for life that he uses in retirement. So this is a great advantage because you're able to gift up to $350,000 into a 529, and then the excess turns into a Roth IRA. That's a great estate planning tool if I've ever heard of it, because they're not going to be able to spend it all in one place. It's building a retirement pot for them if they don't use it for that education. Now, the drawbacks of a 529 plan is that it's a state registered plan. So you will want to have a US individual or address on that account because none of the providers will allow you to set it up initially with a UK address. This is even more beneficial if you have a grandparent or such that is back in the United States and can go ahead and establish the fund and you gift to the benefit of that child. If one child doesn't use all the funds, you can move it from brother to sister, etc. You can even move them up. I've known of people that have actually gone to golf school on their children's 529 plans. Maybe we should do that, Nathan. We can go hit the links together. Essentially, you just can't go down. So it can't go from your kids to the grandkids. So it can't be used for generational skipping. But a great tool because it grows tax-free. If it's used for education, it comes out tax-free. And if you don't use it, it turns into a Roth IRA. So wonderful tool, limits to the amounts, but they're quite large. Now, I'm going to skip the Coverdales because essentially the 529s are more attractive in 9 out of 10 situations. But I want to go into those custodial accounts because it is a little bit of a rock and a hard place when it comes down to it. As Nathan was saying, it's hard to set up a junior ISA unless it's a cash junior ISA, which won't be beneficial if you're trying to save for university in 10 or 20 years. And custodial accounts are state registered as well in the States. So we need to have a US individual. Now, the advantages of a custodial account is that there are no gifting limits. You can gift as much as you want. You might have to pay gift tax on those assets, depending on who's giving the money and how much they're giving. But there's no limits of how much can go into them. Depending on the state of whether it's an UTMA or an UGMA, a Uniform Trust to Minors Act or a Uniform Gift to Minors Act, the age that the child will reach majority and therefore be able to take the money is either 18 or 21. But you'll need to have somebody in the US that will be able to act as the custodian in that given state to have that custodial account. So maybe a grandparent, a brother or sister that can help with that. International trusts, a UK trust can be established. Typically, these are for larger gifts to make it so that it's fully compliant in both jurisdictions. But a great way to have a custodial account in the form of a trust and setting that up. All of these can be set up with regular savings, so monthly accumulation in dollar terms, and essentially they can all be built on either the US or UK systems, i.e. they can receive pounds or dollars inside of them. So not always easy when it comes to gifting money down to the children. Much easier if you have relatives or friends back in the States that can act as the custodian for your children.
Yeah, indeed. And I'd say trusts, they have a place, and there's good ways to use trusts, but it's definitely an area where getting specific advice on what it is you're trying to achieve, and making sure the trust is set up in a way that actually achieves that, considering both the US and UK rules, which do differ sometimes quite considerably on trusts. So as Brian says, because of those complexities, that sometimes leads to that needing to be a larger pot rather than the first place to start. Quite often, I'd say, Brian, that people start with just having an investment account in their own name, but just having it slightly set aside, and in their mind going like, well, that's the education fees that I'm saving over there. Pay tax on it as normal along the way, but it retains it completely flexibly. It kind of is available as and when needed, and there's no kind of additional headaches that you might need to think about loopholes or things you have to jump through on others.
Absolutely. And I'm a firm believer that you want to make sure that you take care of your retirement planning first before you save for the educational planning too significantly, because you don't want to be counting on your kids having to take care of you in retirement. You want to be able to take care of yourself. So sometimes you're able to delay where you're putting that money for educational savings accounts, because you might be able to borrow the money in interest-free until they get out of their university and start repaying it at that point in time, or start helping them at that point in time when you have all your retirement plans all set.
Indeed, very good. Well, I think that takes us towards the end of our kind of formal things that we wanted to talk through today. So perhaps if we move on to Q&A and have a look at some of the questions that I see have been popping through. Just as a reminder to everybody, there is a Q&A function on your screen. So if you can find that, you can click into that, type in your question, and we can pull out as many as we can and try and answer what we can in the time we have left here. Kat, my colleague, is going to join us and perhaps help answering some of those questions along the way, perhaps just to save my voice, but also give you some sensible answers. And let's have a look and see some of the first questions that have come through.
So I'm going to apologize, Tony. I used too many acronyms in there. SE is just the self-assessment. So if you use the self-assessment on the HMRC website, you'll be able to actually dictate and get those forms over to them.
Very good. Someone's asked a question here about what we mean by remitting to the UK. Now, this is a bit of an odd one, and probably a bit of a UKism in terms of remitting monies to the UK. There's an idea as a non-UK citizen, a non-UK domicile, that when you first come to the UK, you can leave money outside of the UK, not pay tax on it in the UK, and as long as you don't bring that into the UK, it doesn't become UK taxable. And that act of bringing the money into the UK is called a remittance. And typically that means you've spent it in the UK, you've used it to buy UK assets or services or things like that. Now, if you have gone down that route of leaving money outside of the UK, you've claimed what's called the non-domicile status, and you're paying tax on what's called the remittance basis. These now start being additional terms and things like that are perhaps a whole nother session and webinar. You do need to be mindful of what's called clean capital or mixed capital. Clean capital being money which is money that has either been UK tax paid already or was capital that you owned when first arriving in the UK. any accounts which you've left offshore, haven't paid UK tax on, and have accrued income, have accrued gains, or any other profits in there, those are now what's called mixed funds. If you bring any money into the UK from those accounts, HMRC is going to view that on the worst basis first, i.e. they're going to assume that the first money you bring into the UK is untaxed income, and so they're going to tax you as it being income. The next bit is going to be capital gains, and of course you need to prove and show them that it's capital gains rather than income. And only finally, once you've emptied the account of all the income and gains and paid all the tax and all of those things, are they finally going to say, okay, now you can bring in your original capital. So you have to be really careful when you're thinking about leaving money outside of the UK and paying on the remittance basis, as opposed to just coming to the UK and paying on what is kind of the normal basis as such, the arising basis, and reporting everything to the UK, reporting everything to the US, using the double tax treaties, and just paying tax as you go, effectively. So there's potentially pros and cons to both of them, but you really do need to be careful if you are using that remittance basis.
Yeah, we had a prime minister that had a little bit of a struggle with that, didn't he?
That's it. It's potentially a basis that might not be around for too long if certain politicians have their way with it. But yes.
Let's see. Okay, so we've answered that one. I was under the impression that 529s were more complicated if you're a UK tax resident and with whether a beneficiary comes back to the UK to live after attending the institution. From what you said, it sounds like that isn't the case. So as long as they're a US individual when they take out the money, i.e. US resident, essentially it's not problematic. And if you roll it over into the Roth IRA, then essentially it's actually instituted into the double taxation agreement. The main aspect is the formation of the account that's problematic from an administration vantage point, and the declaring it in those years building up to that. That's where we would prefer to have a grandparent or a brother and sister on the account. Do you have any other insight on that, Nathan? Or
yeah, I think some UK-based tax advisors, have a look at 529 plans, and it's not specifically something that is dealt with, I think, in the double tax agreements between the UK and the US. So it can potentially fall into the world of trusts, which, as we say, kind of have those slight complications. So potentially, if a person who is residents in the UK paying into a 529 for a child who's residents in the UK and then spends the money in the UK, HMRC might look at that and go, well, what is it you're trying to achieve here? But I think you're right, Brian. There's potentially more flexibility when it's a grandparent who's resident in the US paying into a local state 529. And the child goes to university in the US, that's kind of more akin to that's what it's designed to do. So I think if you use things for what they're designed to do, and you pay a little bit of care, you should be okay now.
Absolutely.
I think, Kat, there's probably a question for you in that. What we haven't particularly covered in the session is insurance too much, and life insurance is one of those things which is not an investment based consideration, but certainly when we're thinking about that estate planning, the lower levels of tax-free allowance in the UK from an estate planning point of view. Life insurance is something that is sometimes considered for people perhaps early in retirement before they've done significant gifting, isn't it?
Yes, absolutely. I mean, we've focused on retirement and investment so far, but insurance is a big part of financial planning as well. And it may seem that it's difficult in the UK to get an insurance policy for someone with US citizenship, similarly to the investment universe, but there are options out there, and we always cover it as part of our holistic financial planning discussion. And it might be part of the estate planning, but sometimes it's just part of your family planning in younger life. You know, when you've got young family, when you've got children who are dependent on you, or someone in poor health as well. So we do take into account all these potential circumstances, and could definitely help there as well.
I think it's another one of those things, isn't it, where perhaps because there's more limited numbers of providers who are willing to work with people who are dual US UK considerations, being aware of what your employer offers can be quite useful, can't it? Because they often ignore those kind of things and say, hey, you're an employee, you can join the group scheme. Can those be, you know, useful and worthwhile?
Absolutely. So, I mean, it's always good to have a chat on what you have in place already, what your employer provides. Quite often you can get a good death in service cover, which will be useful in cases that I've mentioned. So, for example, cover for a young family, for your dependents, for your spouse. But that's a starting point. So this is where we start our discussion and check the level of cover available, and from there we can go to more complex situations and more availability of other products.
Right. Well, I think we've rocked on through the hour here quite quickly, haven't we? So sorry to those who haven't had their questions answered yet. Please do reach out to Brian Catt or myself with any additional questions. Thank you very much for joining us, and we look forward to speaking to you again soon.